Welcome to Momentum Monday. Today is September 18, 2022. Howard, how was your cycling trip and where you're located right now?
Been going to bed. It's midnight, but the show must go on. So depressed. I'm hoping you have some bright spots. I survived. My goal for the last week has been survival, and my critics will be disappointed I survived. But I'm flying tomorrow, so there's always a risk of my demise. Going to Tel Aviv tomorrow, and it's been a great week. Birthday off the grid. I think we've been telling people like it's a good time to do sales or nothing, and the markets seem to be agreeing with my thought process. What's happening?
Yeah,
I mean,
mean,
I watch from the sidelines. Oof, it's ugly.
it seems like every little bounce is getting sold. And last week we had that new August inflation numbers. They came year over year is still over 8%. It seems like inflation will remain sticky for the next few months just because the year over year comparisons are so low. But month over month, we're not really seeing a slowdown. And this is what's really kind of worrying the market, or at least the market is interpreting it that the Fed is not going to slow down anytime soon. So if all the central banks continue to raise interest rates, and at the same time, we are already seeing that there is a contraction in credit, obviously this will be felt at companies' balance sheets and companies' profits and at the unemployment. So the market is definitely worried about two things. One, that the Fed might be fighting yesterday's battle. I mean, obviously inflation is still high, but the way things are going, there might be a recession coming next year. At least this what we can judge by the guidance from FedEx. Like a couple big companies reported last week. FedEx, I mean, they lowered their earnings guidance by like 60-70%. That's a huge drop. They had the biggest drop, I think, since 1987, big one-day drop. And the other one was like a steel producer, Nucor, also big downside guidance. And this is one of, a typical cyclical name. And we're starting to see some signs that
Where's Alcoa? Like that was such a fucking
similar, like anything. I mean, they kind of trade
that
together.
was just $90, and everybody was like,
It's been halved.
"We are in a serious recession." I
I
mean, it's a
mean,
serious recession.
not yet, but the market, as we know, tries to be forward-looking, maybe looking 6 months ahead and saying there is a chance for that. The way central banks are going, would not be a huge surprise. And yeah, correlation have been really high. Stocks have been dropping and bouncing together. The one sector that seems to be kind of immune so far to the market sell-off is anything related to new alternative energy, like be it solar. Like look at First Solar, it hasn't even tested its 20-day moving average. Like it's probably the strongest stock currently in the market. Look at those big blue bars, solar accumulation. And other solar stocks are looking similar. ENPH, SunPower. It seems like the one sector where there is guaranteed demand and government subsidies is holding better than the rest. And it's not just solar, but anything related to clean energy, like electric vehicles. Look at Tesla, it's the best holding mega cap for sure by a mile. Even like smaller companies like Rivian, definitely holding better than the rest of the market. And also lithium, we use lithium in like for EVs, batteries, and in solar panels. Both stocks, let's look at weekly, like this is Livent Corporation and AOB. I mean, they're like 3 or 4 others. I'm not saying that, if the market continues lower, they can't have a 30-40% drop, but relatively, just looking at the relative strength line, has been rising. So definitely showing some accumulation here with the volume bars. Like if you compare it to the market, like the market is showing distribution. The big bars are red. And we're seeing accumulation in that so-called, I'm not sure if clean energy is the right term, but let's call it alternative energy for sure. some accumulation in that sector. So
Yeah.
that's basically the last remaining bastion of upside momentum. Everything else is kind of trading together, and I think we have FOMC meeting next week. Probably a 75 basis points increase is already been discounted by the market, and the market will be paying attention to what the Fed will say their intentions are for the future, if they continue, if they will remain as resilient as they have been so far. Because as we know, the whole premise behind the summer rally, and it was a pretty significant bear market rally, was that the Fed will pivot because of the threat of recession. So far, I mean, the Fed has been very clear. It's not pivoting. Inflation remains high. I mean, probably you can see it from your perch too, how, I mean, the government is coming up with new spending bills. Companies are raising salaries, not only private, but also public companies. Like the railway workers just received a 25% increase. And in all other industries, especially unionized, they're getting big and probably deserved paycheck increases, which will impact inflation. So I don't know what you're seeing, Howard.
Well, again, I'm seeing the countryside. So I'm in Italy. I've had, let's say, I've been 40 hours this week on the bike. So that's a lot of alone time to think. So let's go through the bear case. That's quite easy. Price and volume. Let's pull up S&P and the NASDAQ, because I don't want to go through all the stuff we've been talking about for 6 months of why we've been
All right.
negative. Okay. So we're firmly, I think there's like the most since 2013 I posted, and it caught a lot of people's attention. I forget who shared. This is the longest we've been below, or a certain amount of stocks have been below the 200-day moving average since 2013. Okay. So here's the bearish case: is everybody's still over allocated to stocks, and it's not their, just people haven't seen this since 2013. Okay, and look where we've come since 2013, right? When, the last time we kind of saw this kind of sideways to down action. So there is some good news that obviously things look bleak when stocks are below the 200-day moving average. But what I've been, and you have been telling people, is like, you don't have to be a hero. Bad things happen when we're below the 200-day moving average. So go into the weekly. Like, you don't have to be a hero. Generally, if this is the bottom, great. We already have identified where the future is. It's going to be solar. So what you're calling the last bastion could be the first bastion of a bull market. So who cares if you're right or I'm right? The good news is, if you're wrong and I'm right, and it's the first bastion of a bull market, great, because that means there's some new bull market. Money is going to pour into growth because of this new bull market. And yeah, it doesn't mean it's good news for stuff that's lagging, but there'll be all kinds of new money flowing in, and there is plenty of capital out there. So that's the good news. But I'm saying the bad news is just the price action. Okay. And there's bad price action through tech, financials, biotech, even though there's been some rallies. It's just widespread bad price action, and bad things happen when we're in this position. We know all the bad stuff about rising rates and the Fed being behind and the war in the Ukraine. I mean, it's all on the front page. So really the only thing that can happen now is some sort of panic, and that will be caused by something breaking, right? With the US dollar being this strong and interest rates rising, this is a bad situation for people that owe the United States money, right? The cost of this debt rises. So at some level, the United States can't afford this because we're the lending everybody. So right now, what can happen is, because we're below the 200-day moving average, there's signals that things are breaking. Okay, but there's also, like you said, signals of some strength. And I can confirm that strength in these areas by what some people who have been right a very long time making bets are doing. So Chris Sacca, who worked at Google, then had one of the best venture capital funds of all time, and then kind of retired, came back last year and raised a big climate fund. Then you have Fred Wilson, who I just sat with, and he's had an incredible run in media and tech and social media. And he started making climate and was telling me about a nuclear investment that he made. Now these are people that like came out of MIT and Google and got many trends right, and now they're completely changed what they were interested in and learned a new subject and are focused their life's work on this, like what you've been talking about, alternative energy, which is related to climate, and nuclear energy, which is related to oil. So the good news is really smart people are making really long-term bets in completely new directions for themselves. That's a good sign because they're smart people and they've been right in the past. Okay. And they're taking reputational risk and their LPs risk to make these long 10 and 20-year bets. Okay. They could be completely wrong. Don't get me wrong, but the sign, they've been right before. Then you have the price direction that you're pointing out in chemicals and solar and the Teslas of the world relative strength. And even the biotechs, even though they've been so weak, they're showing relative strength recently. So there are some good signs. But overall, you have to honor the fact that the indexes are below the 200-day moving average. Government's a mess, no good politicians, yada, yada, all the stuff you're seeing in the headlines. So we need to see a lot more good stuff before you can really put serious money to it. And while all this is happening, everybody's hiding out in Apple, and we're seeing what's happening with Apple. Despite all how great Apple is and how dominant they continue to be and how much they continue to stick it to their competitors in new markets, now being Facebook, you can't get anywhere, right? And that can be read both ways, but now it's below the 200-day moving average, and you can see the increasing on the red days, on the down days, you can see the increasing volume, right, Ivan? So you got distribution in the biggest company in the world. So people are looking to this last bastion. Now, this could be a good sign, meaning it's the beginning of the end of the bear market because Apple dropped 20, 30%. You'll look for stocks with relative strength and a new bull market can resume. But I just don't think it's going to be that easy. So, I mean, that's really what I'm looking for. You have these really smart people completely flipping their careers and going in a different direction from what was the trend of the last 15 years around mobility. And I would say this myself, I'm away for a month, completely away. And I'm so connected, right, productivity wise, that there's no stress. 20 years ago, if you couldn't leave your office for a month and be productive, right? You could focus on one thing, whether it was business travel or a vacation, but like there was chaos, right? When things go. Now I'm completely connected. I can ping you 5 minutes on a Sunday without a plan and get our Momentum Monday done. You know what I mean? Like there's and all my email and all the family stuff, texting and pictures and updates and status. So like productivity wise, the world is set up to do great things. It's just there's this huge misdirection in capital from this long bull market. And there's just a lot of capital being wasted and fluttering around. But there are signs, as you see in the prices of energy, that are good. And the one thing I do worry about at Apple is just eating so much market share of so many other companies, and you just can't have one company ruling. And what are they? I don't know what percentage of the index they are, Ivan, but like it's just eating
Look at
away.
Meta and Google already made New Year today lows last week.
Yep.
Like way
So Bang is disappearing. Netflix already is a mess. Microsoft seems to be finally fading.
Same thing, new lows.
Yeah. Adobe, which is
Well, they made big acquisition. That's why
I understand, but the stock was weak before that, and then they
Yeah.
just laid out 20% of their company's valuation. What's their valuation? 140 billion. So they laid out almost 15% of their company for a 10-year-old company. You know what I mean? So there's just a lot of chaos and a lot of mixed signals. And so many of the old guard are breaking. Like to think that Apple can avoid this kind of technical fate seems like folly. So the real question will be, if Apple were at $100 tomorrow, what would the world look like? And I don't know. And if Apple was at 180 and breaking out to new highs, what would the world look like? And like without that knowledge, it just seems like a crapshoot out there in general. So I'm just still don't have like a clear direction of how to put real capital to work in the markets. Now, for people that dollar cost average every month, bad months are better months to dollar cost average, I think. So you just keep doing your thing.
Speaking of that, last week Stanley Druckenmiller came out with an opinion that probably the next 10 years will be just big range bound markets and zero returns for passive investors. What do you think about that? Just similar to 2000 to 2000 and
that would make the most. I mean, that would be a pleasant surprise because blindly allocating every month in the 60-40 portfolio has worked for so long, and now that blew up this year with bonds having their worst year on record. So it would make sense that now that everybody's agreed that passive investing is better than active investing, including yours truly, for most, that passive investing or just index investing would underperform. And I totally agree with that, right? But it doesn't mean that you should quit your day job and begin picking stocks. And if you are going to do that, try and still understand how the markets work. You don't have to be technical analysts and draw lines, but like the weight of the market, when the markets are below the 200-day moving average, like lesson number one is your odds of outperforming the market will go up if you're great at understanding the markets, but also if you're just some kind of simple generalist, this is not a great time to be testing your skills against experts, because like we've seen with FedEx, these mistakes happen in the downside. And let me give you a story about FedEx. They've spent 8 years, give you an anecdotal story. They spent 8 years fighting off Amazon, right? And thinking about, how to beat Amazon and fend off Amazon. Anecdotally, there's this whole market. For example, I tried to, as I traveled, I was trying to ship my bags ahead of me, right? Because, you got all these costs and you don't want to, I'm away for a month and a lot more people are going to be traveling. And I figured I'd ship my bags to ahead of me so I don't have to like lug them through 5 airports, right, to get my stuff done. Thinking that, it would cost me $300-400 to ship a heavy bag to Italy and just save me from going through 3 airports on the way and having my bags lost by the airline. There is a price that I'm willing to pay. Anyways, I go to the FedEx store and it's like $1,000. Okay. And at that point, I don't care how rich you are, you just look at yourself and you go, $1,000, I'll just fucking carry my bag on rollers, through these airports. But so they've outsourced this decision making on, this $1,000. I was willing to do a deal with them for $400, $500, $600, but they've outsourced this franchise of their brand so much that no one can make a decision. And FedEx is chasing these Amazons of the world, and there's like a prime model for wealthy people that I would have paid $600. So they leave $600 on the table. So in chasing all these pennies in Amazon, FedEx is really leaving a lot of market share. They're all chasing this mass shadow of Amazon, and there's all these meaty markets. Anyways, I ended up shipping my golf clubs through Shipsticks, which is kind of like a golf bag shipping handling company, and maybe and it was $200, right? So there are all these weird opportunities in the market for small and mid-sized businesses to grow underneath these behemoths that are fighting each other. And so again, that I don't know how that plays out in the public markets, but like I said, there are all these opportunities left by this gap between small and gigantic companies that will get filled. And like I said, Adobe's paying $20 billion for a company that was started 10 years ago called Figma. So, there's opportunity out there, but in the markets, like in the actual public markets, Druckenmiller has been right a lot. Saying about passive, I'm not going to argue with Stan Druckenmiller. What do you think about the passive?
I mean, it kind of makes sense. It seems like market is cyclical. It goes through like periods of 15 to 20 years of strong bull market, and then the next 10, 15 years are kind of sideways range. And being sideways for 10, 15 years doesn't mean that there won't be like cyclical bull markets that would last 2-3 years, just like we had
Right.
between 2000 and 2012. If we
Yeah.
go back, we still had some rallies. We still had some big individual stock winners like Apple and BlackBerry and oil and potash. Like there'll be some big trends, even in a sideways market for the next decade. There'll be some big trends. There'll be companies that will go up 1,000, 10,000%. So just pay attention to price action.
Yeah, the price action, like you said, for a few weeks, is sort of a month or two, has been in solar.
Yeah, so far, definitely the sector that is holding well. You can see it at
it looks just
this is some
incredibly strong.
monthly.
Look at the volume.
Yeah.
Money is getting put to work here. We need the industry to grow for it to carry the averages, and this is what Druckenmiller is probably thinking: is you got all this capital, which will get indexed because you have so much capital. The governments around the world have been printing money for 20 years. So there's too much capital and not enough growth, right? So you're seeing the first signs of where growth is. The best VCs of the last 20 years have pivoted into climate and nuclear and weird energy ideas, right? Because that's where they see that's what they're paid to do. The smartest people who have the best track records are making new kinds of bets. And that's Union Square with Fred and his team and guys like Chris Sacca, right? And like the media taxis people is like climate, all kinds of weirdo fringies, right? So while all this money has been pouring into crypto, some really smart people have moved on from crypto in many ways into this other world. Because crypto might just be what it's meant to be, just for trading and just for clearing and other things. And the real big misdirection will be all this money that didn't get put towards what really matters, which is alternative energy, food stuff, chemicals, and like you said, the sun, solar. So those are the good signs for people that want to get ahead of this curve. They got to break down these ETFs. Like you go through the solar portfolio, TAN. You can go to Koyfin and look through all the components of these things and start doing the work on the fundamentals, or understand you might underperform and just buy the ETFs from within these. But now you can do the work as like you can go to Koyfin for free and look a bunch of these ETFs up and start scanning some of these companies and following independently. But it ain't going to be the same bull market. When you have Google's not going away, but when you have these companies breaking the new lows, these are not like, this is going to take a while for Google to get its mojo back, right? And it's going to take maybe never for Facebook to get its mojo back. And it's Netflix is not going away, but the competition is here to stay, so money's looking for clear paths to growth, and this is just a really big bear market that's going to set off these new trends. Anyways, I'm going to go to bed.
All right, Howard.
I'm talking to a lot of great founders in Israel, so I'll have some other opinions next week. Ivan, have a great week.
All right, see you next week.